Folks, welcome to Paisa Vaisa. I'm your host Anupam Gupta, B50 on Twitter, and my guest today is among the oldest wealth management firms globally. I'll be talking with Ashish Gumashta of Julius Baer India, and we will be talking about everything from outlook for markets, what's happening in wealth management, trends, asset classes, all of that right after this short break.
इन्फ्लेशन, फिस्कल डेफिसिट, जीडीपी, एमएसपी, एनपीए, इक्विटी मार्केट वगैरह वगैरह। दोस्तों, हमने सारे शब्द टीवी या अखबार में जरूर देखे होंगे या फिर सुने होंगे, पर हम में से कितने लोग हैं जो ये जानते हैं कि इन सब का सीधा प्रभाव पड़ता है हमारी सैलरी पर, हमारे इंक्रीमेंट पर और कमबख्त हमारे खर्चों पर। दोस्तों, मेरा नाम है अभिनव त्रिवेदी और मैं बात कर रहा हूँ इक्का दुक्का इकोनॉमी पॉडकास्ट से, जहाँ पे इस तरह के इकोनॉमिक और फाइनेंशियल टर्म्स को मैं जोड़ूंगा सीधा आपकी जेब से। हर मंगलवार एक नया एपिसोड सुने IVM पॉडकास्ट की वेबसाइट, ऐप या फिर किसी भी अन्य पॉडकास्ट प्लेटफॉर्म पर।
And welcome back. Ashish, welcome to Paisa Vaisa. Thank you so much for doing this for our listeners.
Thank you, Anupam. It's an honor for me to be on this show and to be hosted by you. So thank you so much for inviting me.
Very kind of you. Thank you so much. So let's start. Tell us about Julius Baer globally and then Julius Baer India. I mean, globally, of course, I don't know whether I've got the pronunciation right because I'm pretty sure in German it sounds a little bit different. But tell us about Julius Baer globally and its presence in India.
Right. So, Anupam, Julius Baer is one of the oldest private banks in the world. And in the global space of private banking, there's something called pure private banking. What pure private banking means is you have no conflict of interest. You're only representing the customer. So, it's one of the world's largest pure private banks. The history goes back to 130 years. And subsequently, most of our shareholders are institutions, pension funds, and I'm given to understand that it's over the longest history of dividend paying. So our basic focus is on private banking, internationally and locally. And as you're aware now, the world is getting wealthier, the kind of money which has got printed. So we are present across almost 25 plus countries. And India is one of the top five focus markets of Julius Baer. So that's a very quick perspective on the international side. In India, Julius Baer operates in 7 cities, and we are in all the metros. Plus, we are looking for expanding across India. Our primary focus is on, like I said, on private banking. Globally, we manage about $500 billion of assets, and the whole idea is that in this complex world of wealth, how can you simplify things, and how can if you really see there are only three asset classes: you have debt, you have equity, and you have alternatives. How can you allocate assets properly, and how best can you manage that for your clients? So that's
Yeah.
broadly what Julius Baer is trying to do.
And just for our listeners to understand, because out here in India, the concept of private banking is a little bit different. Like, you've got banks, and then within that, you've got banking service to say HNIs and family offices, which is called private banking. Whereas I think globally it has a different connotation. So if you could just tell us, give us an idea of the kind of clients that you service, maybe that might be helpful for our listeners.
That's right. No, thank you for asking this question because I think wealth management is one of the most misunderstood terms across the world. So there are three things which we are trying to do. The first thing is manage wealth for the high net worth and the ultra high net worths, and broadly, it is $1 million plus category. So which is 7 to 10 crores plus. So that's our primary focus. As you are aware, Indians, there's been a significant amount of wealth creation which has happened in India. So across industries, across businesses, a lot of wealth creation has happened. We have the tech industry, we have the pharma industry. Indian businesses have gone global, and within Indians today, you have global families. So most families you'll come across will have one part of the family living overseas, somebody living in India. We think this global private banking is a big opportunity where families are living across borders. They have wealth here, they have wealth internationally. So our primary focus, what we are trying to do, is manage wealth for the high net worth and the ultra high net worths. That is what we really try and do. This comprises of three segments. First is managing money for them. As you are aware, in India, all resident Indians can only invest in India, and you can take $250,000 overseas. So the first part is managing wealth for you in India, and if you're looking at diversifying, then investing for you overseas. The second part is anything to do with the business. So we have multiple tie-ups in terms of trust, structuring, lending. We have a NBFC which lends money. We have investment banking tie-ups. So any other financial related challenges, which a family faces, we try and work around it. So this, if you really simply put it in the jargon, is called pure private banking. And the licenses in India that you need for it is basically you have to have the licenses for advisory, and you should have all the licenses for execution. So that's simply put wealth management.
Yeah, and we've had a few wealth management firms on Paisa Vaisa. We've had Entrust,
Yeah,
we have
yeah.
had Validus, and we have had Waterfield 3 that I can remember. So it's great to have one of the oldest players globally out here. So Ashish, let's talk about wealth management. You just spoke about how in the last few years that bracket has increased, that cohort or whatever they call it these days have increased. But has how have the HNIs, ultra HNIs, family offices been doing broadly in the last 4 5 years, when of course this big bump up has happened? And any key trends that you see in this area in these very volatile, I would say 6 months, or maybe since the equity markets topped out in October of last year, any trends that we can talk about your clientele?
So you mentioned the three houses that you have interviewed. So in a way, we do a combination of all what the three of them do. So it's an end-to-end kind of a proposition. So Indian high net worth or ultra high net worth has evolved very very significantly. So there are three key events which has happened in India. Number one, we've become global. So a lot of international players have come in and invested in Indian businesses. So Indian promoters have formed JVs, partnerships. They have sold businesses. That has been the first source of wealth creation in India. The second big source of wealth creation has been asset prices which have gone up. So real estate prices which have gone up, etc., etc. That's been the second big source of wealth creation. And third big source of wealth creation has been professionals. So you suddenly have CEOs, CXOs, the kind of wealth tech industry has created. Now, all this combined makes India a very, very interesting proposition. If you remember in the 90s, we had a very high tax rate, we had a very simple tax regime. But that has changed with dividend laws changing, tax creating, and people have realized that financialization of wealth is very important, because the biggest advantage that private banking or wealth management really offers you is liquidity. And a wealth management player, like, to give you an anecdotal example, I would say 80 to 90% of our assets a client can raise cash within 72 hours. So what private banking industry offers you is liquidity, and that is what promoters have realized. So in my view, there's major financialization of wealth which is happening, and which used to be unorganized is getting organized. So I think this industry has just seen its early days, and it's got a great future ahead. People are understanding what is professional wealth management, and as we go along, I can talk to you more in detail what families have been doing, or what is it, how are they thinking about it. But broadly, the shift is unorganized to organized, significant wealth coming in, and people now wanting to seek professional help in managing, rather than having the traditional family accountant, or the trusted advisor managing money. They want to professionalize that service.
Yeah, I can understand that, because this probably was supposed to be in the domain of, say, Main Street banks, right? Because the bank is the most basic financial product, and if I'm someone who's working for a large bank and I see that my client has got a sudden influx of money, I would probably offer him or her some kind of service. But obviously this is specialized, which is why you've got very large significant books, probably an IF, a Kotak, and the three that I mentioned: Entrust, Validus, Waterfield, and then of course there's Julius Baer. So let's talk about that. What are the services that make this area of wealth management so I don't know, precise, something that needs to be personalized to their clients?
That's right. So, if you really ask me, the business is very simple, but to keep things simple in life is not easy. And I think the expertise of a global firm lies in trying to simplify things for people. So, what we really try and do is achieve three things for a client. First is make sure you get the asset allocation right. Now, it sounds very simple, but human behavior is, we are Homo sapiens, right? So we are trained to react to information, and typically we do the opposite of what we are supposed to doing. So like as we go and talk about products, very often things are very simple, but we don't try to simplify things. So the first key thing, which as wealth managers we try and achieve, is make sure that we are able to convince the client on the right asset allocation. What is it that you should be in debt? When is it that you should be in equity? When is it that you should be in alternative? Which is the right mix which you have to take? When is it, if you're taking too much risk in your business, then you have got to be conservative on your portfolio. If you're taking too much, if your business is doing well and it's doing well, then so the first key thing which we try and do is asset allocation. The second thing is families' objectives keep changing over a period of time. So how do you keep the family aligned? How do you take everybody together? How do you make sure that you're able to take the family along? And actually, Anupam, it's a very boring business because you deal with three generations of people. You meet the same client. It's not like an investment banking that you have a new deal or a new business, right? So you've got to keep sticking to it. You've got to keep doing the right thing. So the second thing is, are you disciplined? And very often, I tell relationship managers, it's not how many things you get right, but how many mistakes you cut at some point of time. So when you're doing 10 things, and if you do two things wrong, you've got to make sure that you correct that mistake quickly. So the second part is following the discipline of this asset allocation, implementing it for your thing. And the third is doing the same thing consistently and making sure that you make your client's life operationally easy, because today there's an information flood. Most of these clients are traveling, they have work, they have jobs. So I mean, this is the science which we try and do. And how do you simplify it? You use technology to really do that, but with a personal touch. So you'll be surprised, but it's one of the most personalized businesses which is here. And while technology is there, we still believe that relationship managers and advisors play a very critical role. So the average tenure of our advisor would be 10 to 15 years. So it takes a lot of time to
Oh,
build this
wow.
business. Yeah, it takes a lot of time to build trust. And we would be managing, we don't give country specific figures, but we are the largest foreign player in the country. So on an average, the average size of the relationship is 10 to 15 million dollars plus. So it's again, you have tech, you have skill. At the same time, it's personalized. The tagline that we as a firm use is big enough to be small enough to be.
Wow. I aside from the ticket size, of course, which is very specific to wealth management, I really like the two, three things that you said: simplicity, asset allocation, consistency, because all of that actually applies to all of us in our own financial plans, irrespective of whatever our, that our net worth is or corpus is. I believe asset allocation has a fairly large role to play in longer term returns of the portfolio, right?
That's right. That's right. So,
And of
for example, if you see large caps today, I mean, you've seen the largest bank has announced a merger, and if you see the stock is down 30-35%. So if you look at anecdotally, sometimes simple things in life would do the right things. And in the last 3 months, you had such a significant correction in the large caps. Within
yeah.
telecom, the largest player is down 30%. So I mean, like I told you, that if we are able to allocate correctly, make sure that we can get the right product mix, I think that makes a big difference. But the art in that is lies in convincing the client that, like, this is a year of preservation. As we go along products, we'll talk about it, but this is a year of preservation. You've had 2 years of great returns. This is the year you've got to try and preserve.
So let's talk about that. Let's talk top down. What are the kind of assets or investments that you recommend to your clients? I'm pretty sure that equities is obviously one part of
Mm,
it, but what are the other, especially
mm.
alternate assets that you recommend to your clients?
Right. So globally, this trend started about 10, 15 years ago, but alternatives now is a very, very big asset class. So just to, I know you have a very sophisticated group of listeners, but just to again simplify life for them, in the world, you can only invest money in three asset classes. You can be in equity, you can be in fixed income, or you can be in alternatives. Alternatives includes real estate, commodities, and I'll share some of my personal views on real estate when we come,
Yeah.
on how we see it. Within equities, you can have listed and unlisted. Within debt, you can have across asset classes, and then you have alternatives as an asset class. Now, in India, alternatives was always a personal way of investing. You have a family friend who's starting a business, you would go and invest in him. Some cousin of yours is starting a business, you would go and invest in him. So, alternative investing as an asset class always existed in India. It's come in a structured form in the last couple of years. And the alternative asset class, again, has a huge opportunity. The challenge, again, Anupam, is that the investor should educate himself in this asset classes, because very often what happens when you invest in the alternative asset class, there's an asset liability mismatch. Your tenure of investing and your tenure of exiting, that happens a challenge. So I'll go into the details of that. So when we talk of alternatives in India, in the fixed income space, we have now InvITs and REITs, which have come in. Investment trusts have come in, and real estate investment trusts have come in. I think the real estate market is getting organized, and there's a huge opportunity here. This is a great fixed income product which is available to our clients. But it's very important that the clients understand that there are mark to market risk opportunities here. Uh, these are real estate assets, which in turn invest in rentals. And rentals agreements are done for 5-10 year period. So when you are in the alternative asset class, in my view, you should take a longer term approach to investing rather than a short. Equities, listed equities offer you the biggest advantage of liquidity. Within 24 hours or within 48 hours, the money comes to you. Same happens with debt. But when you're in the alternative asset class, I think you have to marry the risk return time frame. So the spaces which we are looking at is within equities. We have private equity funds, we have venture capital funds. ESG is a new emerging theme, which I think will grow in the coming years. Within fixed income, you have investment trusts, you have real estate trusts, which are really coming in, and I see commodity funds, real estate funds again coming in this space. So if you really ask me, alternatives in India was an unorganized space, but it will get organized over a period of time. Alternatives had seen very inflated valuations. I think that is something which will correct. And every client should have alternatives as an asset class. In India, we don't recommend crypto, but in Switzerland, we are invested in Ziba Bank, which is a government promoted crypto bank, and we tell clients that they should have 1 to 2% of their assets in crypto again. So alternatives as an asset class should be a part of your portfolio. But जैसे आप when you make food dal, you put masala, so it should be the form of a masala or a joka. It should not become majority part of your portfolio. So right now we recommend 8 to 10% in alternatives as an asset class of the for a standard portfolio. Of course, we have private equity investors who are 70% in alternative asset classes. But for a general client, broadly, we are between 45 and 50% equity, 40 to 45% debt, and the balance in alternatives. That's the way
Yeah.
we are seeing the space. But it will be a very exciting space. I think there's a big opportunity there in India.
Yeah, yeah. So just before we go into a break, Ashish, I want to ask you this one question because the last couple of years has seen, and I use the word that I hear more often, democratization of this
Mhm.
alternate asset space for people of the retail class. Um,
Mhm.
whereas the alternate assets that you're talking about, okay, other than in REITs and InvITs, because those are also available to the
Yeah.
retail investor also. But if I look at startup investing, okay, if I look at private debt, okay, a lot of startups have come up in this space saying that we can offer you the same services that wealth managers give to HNIs, and we can give that to you as part of democratization of the space. Their
Right.
logic being that what separates what they do from us, whereas you are giving a service to a client who's got a portfolio of 10 crores. These guys are probably giving it to someone who has a portfolio of, I don't know, 1 lakh maybe. What do you think about this new, it's still very small, but it gets a lot of noise, lot of publicity on social media. They'll take private debt where you could own an asset or you can lease an asset, or in real estate you could even, you have certain structures out there. Any views on that?
So I think that's the beauty of what technology has done, and I think that's the greatest gift of technology. But the challenge that I see is invariably the retail investor lands up losing money, because if you see the world of private equity or unlisted, typically the best deals go to the biggest players. Then If they refuse, then you go to the next, then you go to the next, then you go to the next. So my advice to the retail investor would be that we have a great regulator. He has done tremendous service to us in terms of regulations, in terms of fee structures. I feel we have the most progressive bank. I mean, when I talk to my colleagues in Zurich, they have very high regard for Reserve Bank of India. I think we have a great regulator, and please do simple things. So what really worries me is when I watch IPL and the ads which come. It's all quick money, just transact anywhere. Actually, investing is a very boring business. The lesser you do, the more money you make. Since I'm a wealth manager, I've been 28 years with Julius Baer. The way I test myself is that I should be able to create wealth for myself, right? And I would not even be spending 0.5% of my time on my own portfolio. But on a post tax basis, I think that compounds more than my salary income from Julius Baer. So my advice to the retail investor would be to keep things simple, not to get carried away. And we have a great regulator. We have great institutions like mutual funds which have got formed, and to stick to that. But as time evolves, more instruments will be available, more tools will be available. Uh, what a retail investor or what any investor has to understand that in the startup world, the casualty rate is 95 to 99%. So when you're building your wealth, you don't want to have that level of casualty, right? I mean, it is, I would say, not like lottery buying, but it is the highest degree of risk which you can take. So when you have reached a certain stage of wealth, you say, okay, that's the reason I said even today when we deal with ultra high net worths, we tell them that look at 5 or 10%, because if you get this right, the delta is very higher. So I'm not qualified, I'm not capable, but with my gray hair of 52 years of age, my advice to the retail investor would be keep things simple. We have a great regulator, we have democratized things, and stick to simple listed products where there is oversight. That's my current. Having said it, I think we are in some headwinds right now. So in the current time itself, I would say it would make sense to be cautious. But
Great.
as we go along, I'm sure rules will evolve, regulations will evolve, private equity opportunities will be available to investors. So I would treat this with a great deal of caution, Anupam. My
Yeah.
suggestion would be to treat this with a lot of caution.
There you go, folks. Valuable advice. Treat with a lot of caution. Keep things simple. Look at the listed space, and we've got a great regulator who will take care of your interest for a regulated product. So, on that note, we'll take a break and we'll be right back on this really special episode of Paisa Vaisa.
Hello, everybody. It's been another awesome, great week on the IVM Podcast Network. On Cyrus Says Cock and Bull, Cyrus, Naveen, Anirudh, and Antarish discuss how Snoop Dogg gave his personal blunt roller a pay hike because of inflation. On Simplified, Chuck and Shrika take a look at Facebook COO Sheryl Sandberg's legacy. On Paisa Vaisa, Anupam talks to Vijay Mantri. He is the co-founder and chief investment strategy at JRL Money. They debunk the myth of active versus passive investing. On the Life Manifesto, Zarina teaches us the value of a good leader through the story The Emperor's New Clothes. And on Smarter with Sid, Siddharth explains how power dressing works. We got some exciting news for you. IVM Podcast has just launched its merch line, and you should check it out now. Head over to the IVM Podcast website, that's ivmpodcast.com, and click on the shop tab to check out our first collection of t-shirts. Also, do follow us on social media. We're IVM Podcast on Twitter, Facebook, Instagram, and LinkedIn. And remember, if you're enjoying this show or any of our other shows for that matter, please do tell a friend. That really does help. Don't forget to rate us on any of the platforms you're listening to us on. And also do remember, you can check out a number of our shows on YouTube. You can go to ivmpodcast.com/YouTube to get a list of the channels that we are keeping active. We also are doing a small listener survey. If you could go to ivmpodcast.com/survey to fill this out, it'll just take a few minutes and it really helps us out. And finally, we'd like to thank our sponsors this week, SBI Life Insurance, Apne Liye, Apno Ke Liye. Jupiter, a digital banking app. Capgemini, get the future you want. Intel vPro, built for business. And Intel, future banao wonderful with Intel-powered laptops.
And welcome back, folks, to this episode of Paisa Vaisa. My guest, Ashish Gumashta, Julius Baer. Ashish, on this second part of the episode, let's talk about outlooks across the asset classes that Julius Baer recommends to its clients in India. And let's start with equity markets. You gave some mention about how large caps have fallen significantly. So let's talk about in depth your outlook for equity markets in India.
Yeah. So I'll try and simplify things, so that while we have a very, very intelligent audience, which is very smart, but I'll try and put things in simple perspective. So we have three or four key trends which are across the world and questions which each one of us are asking. And I'll talk to you a bit about this correction which has happened. So the first is inflation, right? And it is here to stay. We've had low interest rates. A lot of money has got printed. Countries have printed money, and it's in the system. So whether it will be inflation, stagflation is what we will all question and debate. But the fact is that this is the first thing which is here to stay. And in such a scenario, equities is the best bet. And equities and probably real estate is the best bet. So I think as an asset class, that's the first thing which we've got to look at. The second thing is that the US dollar has had its supremacy for a very long period of time. But I think there is a effort, to find alternatives to that by investors globally. The recent Swift code freezing in the case of the Russian crisis. So I think people are looking at alternatives, alternative currencies, and India portrays a great picture to the world. We are a stable democracy. We have robust systems. We have capital markets. We have good reserves. So I think the second key trend is that the world is looking at globalizing. They are looking at alternatives to China. They are looking at alternatives, and I think that's the opportunity for us. So that again, the easiest way to capture that is, and you've seen government do a series of reforms, PLI, the production linked incentive scheme. We've had a host of corporate tax today is probably the lowest in the world. So with all these things, I think we will be a destination to attract capital. The third part is with the supply chain mismatches, and especially oil. I think that is a part which we really need to watch out for. So when you take equities in the big picture, the situation looks positive. At the same time, there are a series of headwinds. So the first thing we as investors have to do is moderate our expectations from the equity markets. The second thing is we've got to understand the big picture. I think we've crossed the threshold. Our GDP has crossed 3 trillion, and we've seen, like, Anupam, if you go to a hotel today, it's difficult to find a table. If you go to the airline, you don't get a ticket. So I think as an economy, we have arrived, and rather than looking at too much information or too much data, I think this agri prices which have gone up will benefit the rural economy. So the sum and substance is that what is happening in the world, I think, is going to benefit us as a country. So in terms of geopolitics, in terms of supply chain, in terms of our positioning as a favored destination, I think a lot of the picture falls into place for us. So if I'm an investor, I would still be overweight equity. Having said it, the next 3 to 6 months, what's going to happen, neither I know nor, I mean, maybe the most powerful guys in the world would also not know, because you have a Russia-Ukraine war, you keep reading about Taiwan, China. So I think whenever these kind of crises come up, these are opportunities to invest. So my two simple bits to the investor would be: the day you think things are worse, the day you feel, and that's the way I personally train myself, that whenever I feel very low or things are going wrong, that is the time to invest in equity. So I think the coming few months will give us a good opportunity to look at equity. So just to summarize, China plus one, PLI. I think with this crisis, the world will outsource more and more to India. Our banks are now in a much better position than where we are. Whatever reforms we've done RERA, we've done X, Y, Z. I think all that will come in. We are politically strong. The ruling party seems to be doing well. We have an election in 2 years, and politically we look like a stable situation. So I think, keeping net all this in mind, we would be positive long-term equity, and short-term cautious, because of all these global factors. Anything can happen. Stocks can correct. So use these opportunities to build an asset allocation. My advice to the clients would be, and if you have long-term money, whatever money you have, 3 to 5 years, I think 40 to 60, 40 to 50% one can look at in equities.
Sure. Let's talk about the debt market in this environment of rising rates, rising inflation, or at least high inflation. What's your view there?
Yeah. So, Anupam, you would have read about the modern monetary theory, right? Where governments will allow capitalism, but they will control capitalism. So uh, across the world, you have inflation which is coming in, but the governments want to keep interest rates under control because the general view which is coming is that this is a supply chain mismatch. This is due to extenuating factors, and by raising interest rates you will actually kill demand and you will not achieve anything. So it's a very, very tough time for a private banker or a wealth manager like Julius Baer or anybody to give you a view in this. But what common sense shows me that today government bonds itself are trading close to 6 to 7%. So if you are in 3 to 5 year maturity, I think our 10 year has crossed 7%. I mean, logically, my advice to the investor would be very cautious, stay in AAA assets, and be in the 3 to 5 year maturity. If you're a sophisticated investor and you have access and you have understanding of credit markets, then of course credit markets give you a 2 to 300, 400% higher return. But to the investor who doesn't want stress, who doesn't want tension, I mean, my advice would be interest rates now look interesting. We don't know where it would go, but it's very clearly that inflation is here to stay. It is going to have an impact with us. At the same time, governments recognize that if interest go too much, it could be detrimental to the economy. So, uh, broadly, 3 to 5 year maturity, be conservative, and don't invest where you don't understand. Is my advice, to the investor.
Yeah, and coming into some place where a lot of people don't understand real estate, and that's a fairly big
Right.
chunk of HNI investment, right? So what's your view there? Because real estate, on the residential side, of course, people say that that there's rental yield is 2%, home loans are at 7%, so forget it. So if you let's not look at that part, but the advice that you give on real estate as an asset, to the fairly
Yeah.
large chunk of HNI investment, what's your view out there?
Okay. So I'll break it into two parts. First is as Julius Baer, and then my personal, because we don't cover this entire spectrum. So I would caution investors that part of it, my personal opinion, please don't take it seriously. I'm not that smart. I'm a professional working in the company for 28 years. So take it with a pinch of salt and use your own judgment. So as a sector, we are positive on real estate. We think it's an asset class one should be in. Uh, I think, again, common sense approach. Uh, all the data is out in public. Look at what the government is rolling out in PLI, the kind of manufacturing which is getting set up. Now, all this is going to need housing space, etc., etc. Here, if someone just drills down on the kind of capex which is coming in, the kind of PLI investment which is coming into India, that itself will show you the scale of opportunity which is coming in. The second is the IT sector. The whole world is going to outsource to India. As global companies cut costs, again, that outsourcing is going to come to India. But this time it's going to be different. It's not going to come to the top two or two, three cities where you have 30, 40, 50, 60,000 rupees a square feet rent, because people have realized that if you're in a Coimbatore, you can work as well as you can work in Bangalore, so, or if you're in, maybe outskirts of Pune, it is better than being in Pune. So I think as an asset class, real estate in India should do well. But again, one should expect moderate returns. What has happened, Anupam, in real estate is that a lot of investors have got out. See, we have GST and then we have stamp duty. That combined is 11%. So a lot of investors and with lower rental yield. So actually, the market has become quite transparent with only users coming in. And if you know that real estate is a great hedge for inflation. So what has happened in the last couple of months is that input costs have gone up very, very sharply for real estate companies. Steel has gone up, cement has gone up, etc. And I think that will have a bit of an impact. But just before I get into it, what we've seen are real estate ultra high net worths do in real estate. So we've seen them buy a lot of land. So they bought a lot of land. We've seen ultra high net worths buy second homes, and we've seen everybody upgrade their lifestyle. So a 2 bedroom guy wants to go into a 3 bedroom, a 3 bedroom guy wants to go into a 4 bedroom. So I think all this will lead to a lot of investment-led demand in real estate. Uh, Two cities where a lot of premium have got paid, which is Bombay and Pune. We'll have to be cautious. If you see public data, uh, uh, most state governments now, Anupam, will raise money by selling FSI or selling premium rights, etc., because it's the easiest way. The whole Chinese economy grew on every state or cantonment selling real estate. So I think Bombay and Pune may see some excessive supply, but Bangalore, Chennai, NCR, I think these are very, very interesting places. So, sum and substance, it's an asset class you should be in. Having said it, registrations and all have fallen this month. So there may be a bit of correction. These are my personal views. Please take it with a pinch of salt. We do look at real estate, but through asset managers. So we give money to fund managers, asset managers, who in turn have real estate products. So I think asset class we are positive. And more and more transparency is coming into the industry. Consolidation of wealth is coming into it. For the equity market investors, one of the ways of taking advantage of that is buying ancillaries, the tile suppliers, those who supply to real. So while real, you can buy real estate companies, but their cycle is very long. But the suppliers, the ancillary suppliers to the real estate, our research is in fact recommending the ancillary suppliers to the real estate industry. So that's broadly, part of Julius Baer and part of my personal opinion on
Sure,
real
sure.
estate.
Actually, let's wind up this episode with the alternatives as a category, and within that, probably a fairly hot area in India for the last couple of years: investment opportunities outside of India. What's Julius Baer's views on that?
Right. So, in alternatives, I think gold and silver still continue to be a hedge against currency. So, with so much money getting printed, with so much of capital being every country has gone and printed. I think as an insurance, one can still look at gold and silver. In India, we don't recommend crypto. We don't advise clients, but globally, we are saying that look, buy a basket of 1 to 2% depending on their comfort. And alternatives as an asset class should definitely form a part of your portfolio. You should look at InvITs. You should look at REITs. You should look at private equity funds. But please have a 5 to 10 year outlook on it, and please spend some time understanding this space because this is a space which is evolving. Whenever something is new, you have to spend time. Like on NFTs, I still spend time reading about it. I mean, so I think this is an asset class here to stay. Like I said, globally, we are telling clients to have this as up to 10% in their portfolio, depending on their risk appetite. But again, please don't borrow money to put in this asset class, is my personal advice. And secondly, have a longer term outlook when you get into this asset class because we may have some challenges in terms of in the headwinds are there. So I mean that's my outlook. Going to your last question on international investing, we've seen that for resident Indians there is the liberalized remittance scheme, and the outflows for that, the investments through that are growing up every year. I think it offers a great diversification opportunity for Indians overseas, and we should definitely be looking at every family should look at diversifying overseas through these opportunities. Again, keep your life simple. Understand the product which you're getting into. Please don't forget the world has only 3 or 4 asset classes. So please don't do something which is very, very sophisticated. But the world gives you a very simple opportunity. Like you have businesses, you have great businesses which are available there now at good valuation. So even as Julius Baer, we brought in 2 of our global funds into India. So they are available through the wrapper. We've taken a wrapper of Birla Mutual Fund, and under that, we have 2 of our best global products which are available. And I think it is an asset class which should definitely form a part of your portfolio, 5, 10, 15%, because again, depending on your net worth and the size of portfolio, my advice would not to be doing contra investing, like just because China has corrected, you invest in it. You invest in it at the right time, when the economy is doing well, the cycle turns. So I think the world gives a good space. Banks are available at fairly good valuations internationally, and I think we'll have a plethora of products coming there. Again, please be cautious in what you're doing. The Indian mutual fund industry again offers you that option. So try and keep things simple.
Yeah. So just on that note, since we are closing now, if you could just tell our listeners a specific Julius Baer product that you're offering through Aditya Birla Sun Life. I think you're talking about the Global Excellence Fund of Funds, or
Yeah, that's
what are
right.
those? Because
That's
I
right.
think those are products where the retail investor can actually invest in your products via the fund of fund route. So what are those products?
That's right. So we have two funds. We have the Next Generation Fund. These are businesses of the future, the best of pharmaceutical companies, the tech companies, uh, great equipment manufacturers, medical facilities, and then the Global Excellence Fund, which offer you some of the best global businesses. Now, a lot of innovation happens outside India, and these businesses and companies we don't have access to. Uh, but as I understand, Anupam, that there is an RBI limit permission which is required overall for the mutual fund industry. So, to the best of my knowledge, that has not come. But the
Not
moment that
coming as
comes,
yet. Yeah.
both these. So one is called the Next Generation Fund. The second is called the Global Excellence Fund. And both these funds, we think, are great opportunities. Most of these businesses replicas don't exist in India. So you're actually generally diversifying your wealth. Again, like I said, the next couple of months there are headwinds. So please invest cautiously. Please invest systematically, and too much of reading or too much of don't every day check the NAV, because when you buy a real estate, you forget your house for 5 years, and that's when you see appreciation. In the capital markets, the problem is you buy today and then next day you start seeing your NAV. So and of course, please do consult a financial advisor. Julius Baer would be a great place to come and take advice from. But that's broadly my views on it.
Yeah, folks. So remember, consult your financial advisor. These are slightly evolved products. The Global Excellence Equity Fund or the Next Generation Fund. These are fund of funds. They have a tax impact. Consult your financial advisor before taking any investment decision. And on that note of very, very good advice, I would say from Ashish, that is a wrap on this episode of Paisa Vaisa. My guest, Ashish Gumashta of Julius Baer India. Ashish, really, thank you so much for doing this for our listeners.
Thank you, Anupam. I'm very grateful that you gave us an opportunity to come and speak to your listeners. Thank you very much.
Please come by again. You're always welcome on Paisa Vaisa. And folks, thank you for listening to this episode of Paisa Vaisa. If you like this podcast, don't forget to check out other interesting podcasts on the IVM network. You can listen to us on the IVM podcast app or ivmpodcast.com. You can also follow us on our social media. We are IVM Podcast on Twitter and Instagram. And if you want to reach out to me, I'm your host Anupam Gupta, B50 on Twitter. And thank you, folks. Really, thank you so much for listening to Paisa Vaisa.
No material on the show should be considered as financial advice. The material on the show is for informational purposes only. Please consult a financial advisor before taking any investment decision.